In this session, let's look at the multinational operations, where I mean a company doing transactions with the companies in other countries. So, buying and selling of the goods in other countries. That is one aspect of multinational operation. Two, having subsidiaries in the other countries. So, in these two cases, how does a company account these kind of transactions? How is it treated in the balance sheet, and how are these transactions treated in the income statement, and how do you translate from one currency to other currency? What are the exchange rates involved in this process? All these things are typically packaged as a part of this session. So, from the accounting standpoint, before we actually take up an example to convert one company's financial or one currency designated financial statements into the other currency designated, or even in this chapter we would also be looking out for what if the subsidiary is a part of an inflationary economy. All these things would be looked at. So before I get started, the first thing I would like to look at is what kind of currencies, what do we mean, different kinds of currencies which we typically talk of. So we categorize the currencies into three major groups. One is a local currency, which is let's say an Indian company. So for an Indian company, the local currency is Indian rupees. Now, the Indian company can typically do its business, means buying and selling to either Indian customers or outside customers, but for the sake of its regular trading, dealing in businesses and all, it may use either Indian rupee for regular transactions, or it may say I'll use US dollar for my transaction purposes. So when a country is using dollar for transaction purposes, we say that it is not using the local currency, or in either of the cases, whatever is the currency that a particular company is using for regular transactional purposes is what we call as a functional currency. It may be same as the local currency, may be different from the local currency, doesn't matter. But most of the business dealings happen in this currency. So probably even if an Indian company says, yeah, I will sell you this good for $50 US, rather than saying the selling price for this good is 3,000 rupees, it may say the selling price of this good is $50 US. The country may be still in India, but for the regular transaction purposes, it is using US dollar as the currency. So generally, if a particular company, for all its transaction purposes, even for the wages to the employees, or for material buying, or for any such kinds, to a large extent, if it is using one particular currency, we call that currency as a functional currency. And which currency to use as a functional currency is completely determined by the management of that particular company. And the third kind of currency which we talk of is the presentation currency. That is this currency in which the financial statements are prepared at the end of the year. The currency, it may be local currency, if at all this company is incorporated or registered in India, then probably it may prepare in the local currency, or sometimes it may prepare in some outside currency also. So all these are the different kinds of currencies which we talk about, and we'll use these different currencies when we are thinking of restating the financial statements or re-preparing the financial statements from one currency to the other. Now, as I said, there are two major aspects that we are going to look at as a part of this multinational operations. One is the typical day-to-day transactions in the foreign currency. The second is having a subsidiary in the foreign country. So when I talk about typical day-to-day operations or transactions in the foreign currency, from a company's standpoint, if at all it is dealing, let's say an Indian company is dealing with a US company for regular buy-sell operations. Now, it is designating the product in US dollars. Let's say the presentation currency is still Indian rupees. The financial statements are still prepared in Indian rupees. So, whenever a deal is done, whenever a sale is done in US dollars, on that date of sale, an entry goes into the financial statement as per the exchange rate on the date of the transaction. So let's say I have, as an Indian company, I have sold something in US for $50, and let's say on that date of sale the exchange rate is 60 rupees per dollar, which means on that date it gets into my financial statement saying a sale was made for rupees 3,000 bucks. If I receive that 3,000 or $50 on that particular day itself, nothing to worry of. But otherwise, the sale, as per the revenues, I will recognize 3,000 rupees. And because a credit was given, accounts receivables also will show 3,000 rupees. On the day the transaction was done, irrespective of whether the payment was received or not. Now, on the day when I received the money, the US company will still pay $50 only. The US buyer will still pay $50 only, but depending on the exchange rate at that time, means if the exchange rate has become 61 per dollar, actually the Indian company is going to receive 3,050 bucks. And because of that, it can represent a gain. It can represent a gain of 50 rupees on the day it has received the money. So the account receivable will go up, and because it has received 3,050 in the form of cash, the 50 will go as a foreign currency gain. So when the foreign currency is appreciating, especially in case of sell transaction, when the foreign currency is appreciating, you will see that the local currency will gain. The company in the local currency presentation will gain, and when there is a depreciation in the foreign currency or appreciation in the local currency, this transaction will typically lose. But the gain or loss on the day when the actual payment is received, the gain or loss is directly treated in the income statement based on the exchange rate that is prevailing on the day of receipt. So let me assume that we have made a sale on 1st March 2030. and of course there is a 2-month credit period. So I am going to receive the payment on 1st May 2013. So on 1st March 2013, there will be a transaction entry saying revenues is 3000 and accounts receivables is 3000. And on 1st May 2013, the accounts receivables will no more exist. The cash will become 3050 because in reality I have made 50 more, and in the income statement there will be a transaction gain, foreign currency gain of 50, which will increase the net income by 50, which means the retained earnings also will keep increasing by 50. Now here there is a small cash. Assume that the financial statements have to be prepared on 31st March 2013, which is in between the actual transaction date and the cash received, payment received date. So the balance sheet date is somewhere in between. So on this day, whenever the balance sheet date is somewhat like this, which means we have done the transaction but we have not received the payment, or probably the other way, we have booked the order but we did not, we have got the product but we did not pay for the product. All these things, whenever the balance sheet date is between the transaction date and the settlement date, what is expected to be done is find the exchange rate on the balance sheet date. So probably let me assume that on the balance sheet date the exchange rate is 60.6 rupees a dollar. Then in this case what happens is you first readjust this transaction, assuming that a sale has been done on 31st March 2013. So probably you would have got 3030 for that. So, but because you did not make a sale, the 30, whatever is the increase that you are expected to get, it goes as unrealized gain. And this unrealized gain also you take it into the income statement itself. Especially for transactions, whatever is the unrealized gain, though you did not sell it. So for this particular year, you can take the unrealized gain as 30. And that unrealized gain you can carry directly into the income statement, and probably the accounts receivable can be updated to 3030 now. Though it is 3000, now that on the balance sheet date the exchange rate has changed, so what you will do is you will update your financial statements based on the balance sheet date itself. So because of that you will make your accounts receivable as 3030, and you realize, though it is an unrealized gain, you take this unrealized gain into the income statement itself. Now on 1st May, when you are actually receiving it, when you are actually receiving cash, so you will remove this accounts receivable of 3030, you will make the cash as 3050, and in that year you realize the gain of 20 more, because what you are getting is 3050, which is 20 more than what the balance sheet date is specified. So this kind of settlements as on the balance sheet date will typically help the companies to spread the gains or losses evenly over the period, or probably reflect the current scenario rather than postponing it to the next period. So whenever the realization is happening, the realities are reflected, but even the unrealized gain or loss, especially in these foreign currency business transactions, we don't carry it to other comprehensive income, or we don't carry it onto the balance sheet. Even the unrealized gains or losses are directly carried into the income statement itself. But the only thing right now that's a gray area is, yes, I will transfer the gains and losses into the income statement, no doubt. But should they go as a part of operating or non-operating income? Because no clarity is given even as a part of US GAAP or even IFRS as to where these elements should typically go. So the only thing that is suggested for an analyst is, make sure when you are comparing two firms and one of them has handled it as a part of operating income and the other has handled the same as a part of non-operating income, convert from one to the other, or move this transaction from either operating to non-operating for both the companies and then do the comparisons. Otherwise, whatever the ratios you are doing, they get more biased, and the choice of investment differs considerably. So that is what I am trying to project for foreign currency transactions. So what the example which we have discussed could be a sale transaction, but the same thing will happen even if it is a purchase kind of a transaction. Alright. So any transaction that is designated or that is handled in a foreign currency, that is what is subjected to the foreign currency risk. That is what is exposed to foreign currency risk, because you will be receiving a fixed amount of foreign currency itself, because we have designated the product. The product is designated in the foreign currency. You will always pay or receive the foreign currency in fixed numbers only, but when you translate it to your local currency, either you may be receiving more or less depending on the appreciations and the depreciations of the currency. That is where the foreign currency risk is possible to be existing in case of foreign currency transactions. Now we move on to the next aspect, which we talk about as a subsidiary based transactions. So let's say a company is having subsidiary in a foreign currency, foreign country. So let's say I am talking about a parent country, whatever it is, and I am talking about a subsidiary in another country. So country X is the parent, country Y is the subsidiary. Now this subsidiary may be either self-sustaining kind or, when I say self-sustaining, it is more and more de-linked from the parent. It's probably parent has invested in the subsidiary, but operations wise and financials wise, everything, it's a de-linked from the parent. So it is self-sustaining, it is de-linked, and it is very much possible that it will prepare its financial statement in its functional currency itself. So it can use functional currency probably as a local currency itself, and it may prepare its financial statement. That is one situation. The other situation is the subsidiary is fully dependent on the parent for all kinds, operationals or financials. So for a lot of things it is dependent on the parent, means it's almost integrated into the parent. In that case, generally the functional currency will be same as the parent's currency, not the subsidiary's local currency, but the functional currency will be generally same as the parent's presentation currency. So whenever you find these kind of subsidiaries, how would you carry this financial statement into this? Because eventually the parent has to prepare its financial statements in its own presentation currency. So, if at all the subsidiary is more like this, which it has prepared in its own local currency, how do I translate the financial statements from this form to the pair presentation currency form? For that, I use the method called current rate method. So, we will discuss each of these methods, but for these kind of subsidiaries, we use the current rate method, especially the functional currency that is used by the subsidiary and the parent's currency. They are very much different, wherein the subsidiary is trying to create and present the financial statements in its own currency. In that case, I'll use the current rate method to translate all the financial statements, elements of the financial statements from the local currency to the parent's currency. But if I see a subsidiary more of this form, where the subsidiary is more or less dependent on the parent and it is preparing the financial statements more or less in the parent's currency, not in the subsidiary's currency, then when I am translating it to the parent, I use a temporal method. I use a temporal method first to remeasure the local to the parent, and which means because the parent functional as well as presentation is the same, from the local to the parent at the time of presentation, I'll convert from local to the parent based on the temporal method. And if these three currencies are different, all three currencies are different, then from local to functional, to convert it from local to functional, I'll use the temporal method. To convert from functional to parent presentation, I will use the current rate method. So, especially if a company is operating in one country with one currency where its functional currency is different and the presentation currency is also different. So, if there are three different kinds of currencies associated, then we can use both current rate method as well as the temporal method. So, basically speaking of, to convert local currency to functional currency, we use temporal method, and from functional currency to presentation currency, we use the current rate method. So, what are the characteristics of each of these methods? We can deal that with the help of one single simple example. The use of current rate method is more or less straightforward. All we do is every income statement element, the way we are translating the functional currency to presentation currency. That is where I am using the current rate method, and in this current rate method, all we are doing is every income statement element, we are translating it at the average exchange rate during the transaction, during the financial year period. We are translating every item of the income statement at the foreign currency average foreign currency exchange rate during the period. And when it comes to the balance sheet items, we are translating it at the current interest rate. The only exception being the stocks and dividends. If at all the company has declared any dividend and probably the stock whatever was issued, we translate only that portion at the historical rate. Rest all are translated as of the current rate itself, right? Whereas when we talk about every element of the income statement, we translate it at the average rate. So let's try to look at one example, right? It's a straightforward calculation. So let me try to look at one example. Right, let me just take a little bit this side. Okay, so I'm having a few data here. The financial statements associated with 2011 and 12. Okay, the balance sheet for 2011 and 12, as well as the income statement for 2012. And also we have different exchange rates. Of course, I'll discuss about all of them when we are talking about the temporal rate, but for this we only require these three numbers. For the current rate, we only require these three numbers, because one is the historical, the other is the current. The historical I require only for equity, whereas the current I require as of the entire balance sheet elements, and the average is what I require for the entire income statement elements. So when I am using the current rate method for 2012, let's say I want to restate the figures into the using the current rate method, I want to translate it into the parent currency. Here what I am assuming is 1 unit of local currency is equal to these many units of parent currency. So this current rate method I am using to translate into parent currency, whatever it is, but what I am assuming is 1 unit of domestic currency, because these are all quoted in domestic currency. So what I will do is I will convert these based on 1 unit of domestic currency is equal to these many units of foreign currency. So here what is the simple thing I can observe? 1 unit of domestic currency is 1.84 as of March 2011, but it has become 1.98. So what is the indication? The local currency has actually appreciated, because if I say for 1 unit of my local currency, for 1 unit of my local currency I will get 1.84 units of foreign currency, whereas in the other way it is saying for 1 unit of my local currency now I will get 1.98 units of foreign currency. So it is an indication that the local currency has in fact appreciated. So this is an indication of appreciation of the local currency or the depreciation of the foreign currency. So based on that let's work out. So in this case we can easily assume that the local currency has appreciated. But whatever may be the case, sometimes it may so happen that in the middle it could appreciate, depreciate, all kinds of things can happen within one financial year. But just to understand or just to get a clarity on whether there is an appreciation or depreciation, we are just using it for an understanding purpose. But when I want to go with a this is the current rate method. The simple thing is, first I will start with the income statement. In the income statement, each and every item I restate it based on the average rate, straightforward. Each and every item I restate based on the average rate. So revenue, I multiply it by the average rate. So this is what is my revenue. The same logic I will give to the expense. So based on this I will get my gross margin is somewhat like this. Then depreciation also I will other expense as well as depreciation, both of them. I will restate based on average rate itself. So every element, when I talk about the current rate method, I will restate it based on the average rate itself. So based on this, I can compute my net income as gross margin minus depreciation minus other expenses. So basically, this is what is the number that is getting worked out in the foreign currency or in the presentation currency. Right? So these many units of presentation currency is what is shown as a part of my net income. Now, once we have done the entire P&L statement, straightforward work, I come to the balance sheet. In the balance sheet, I'll multiply each and every item with, I'll adjust each and every item of the balance sheet with the current rate. So because I am talking about 2012, I multiply it with the exchange rate as of March 2012. So the same thing I'll do for the cash, accounts receivables, inventory, everything. So based on this, my current assets will work out to this particular numbers. So these are my total current assets as a part of the foreign currency. Similarly, I can work out with my fixed assets. These numbers I'll multiply it with the latest rate, the current rate. So if the current rate is much higher, here the stated assets will be much higher, right? So this, even the depreciation, accumulated depreciation also, I'll take it in the same way, which means my net fixed assets this time is the difference between these two coming out to this much, and my total fixed assets is net fixed assets plus the current assets working out to this much of number. The same way I can work out with all my accounts payables and everything, right? All of them are stated as per the current rate itself. So accounts payable, short-term debt, long-term debt, all of them I am stating as per the current rate only, except the common stock and the dividend that would be set at the historical date. So here, just for understanding purpose, I will take the historical date as the last year's itself, assuming that the stock has been issued at last year itself. I am just making one assumption there. The historical rate, I am taking it as the last year's itself, or probably I have one rate for equity, right? Probably let me use that rate. I have one rate for equity here, so let me consider that particular equity rate, whatever the stock has been issued. When the stock is issued, the exchange rate is 1 unit of local currency equal to 1.86 units of the foreign currency. So if at all it is issued on March 2011, then I'll use the March 2011 rate. But if it was issued earlier or wherever, and on that issue date, probably you take the exchange rate as something like this. I will very well consider that as the exchange rate. So this becomes my common stock, and now all I am left with is the retained earnings part. And how do I need to compute my retained earnings? I will go based on the retained earnings that are there in the previous period. I'll translate those retained earnings, right? So I will take the retained earnings in the, this is one key step in temporal method. I'll take the retained earnings of the previous period, translate it at the equity rate itself, and to that I will add the net income of the current period, right? Through the previous period retained earnings, translated retained earnings, I will add the net income of the current period in the foreign currency, and I say this will be my retained earnings which are translated. A very important step in case of the current rate method. And I know that my total liability should be equal to the total assets. So this number I will directly take it as this number. So my total liabilities, I know it should be equal to 25,176 because they are equal to total assets. And this is where I will introduce one additional element. In the current rate method, this is the adjustment account called as the cumulative translation adjustment. This is a value that is going into the current rate method, which is a balance adjusting figure. Total assets minus the sum of all these things: accounts payable, short-term debt, long-term debt, common stock, and the retained earnings. After I subtract all these things, whatever is coming out, so which is 681 bucks of my foreign currency, in my foreign currency, is the cumulative translation adjustment. It's as good as saying in your net income, if I add this, there is a kind of a gain. So because the domestic currency has actually appreciated during the period, because the domestic currency has appreciated in a way during the period, we have seen that the company's profits have actually gone up, and this is again an adjustment figure, assuming the cumulative translation adjustment was 0 at the end of the previous period. So this is the net cumulative translation allowance as of this particular period. So making a translated financial statements into the foreign currency using the current rate method is very straightforward, not too many complications involved in it. So the gain, whatever the difference we have got, is added as a part of the cumulative translation adjustment as a part of the equity in the other comprehensive. So if at all I have to compute the total equity here, the total equity here actually is a summation now of these three elements. So the total equity or total shareholders equity will work out to 12,984, and this method of accounting where the translation adjustment is treated as a part of the balance sheet and not the income statement, we call it as dirty surplus accounting mechanism. Whereas the difference, if I carry it into the income statement, I call it as clean surplus accounting mechanism. So from this company's perspective, we see that the exposure to the foreign currency is purely the net asset, based on the net assets. Net asset is nothing but the total assets minus the total liabilities, which is more of the exposure to the equity of the subsidiary. So if at all the domestic currency is appreciating, right, if the domestic currency is appreciating, we see that it is positive. If I see, here, if I see that the domestic currency here, 1 unit of domestic currency is 1.84 and 1 unit of domestic currency became 1.98. So in this case, actually the domestic currency has appreciated during the period. So the domestic currency, so it's not the foreign currency here. Positive and the domestic currency is appreciating. We will see that the CTA will always be a gain. So, and the other way, if the domestic currency is depreciating, if the domestic currency is depreciating, then it's going to be a loss, and vice versa. That's how we handle this scenario as a part of the current rate method. Now, moving further to the next one, which is the temporal method, which will come into picture when the foreign currency, the functional currency as well as the presentation currency both are same, whereas the local currency is much different from these two. So translating this local currency into foreign currency is what we call as a restatement method, and in this restatement method there are slightly few complications that are involved. So assets and liabilities, first of all, we will classify them as monetary assets and liabilities versus non-monetary. Monetary are something which are directly dealing with cash in some form or the other. Cash, accounts receivables, it's something which I have to get in cash. Accounts payable, something that is settled in cash. Debt, something that has to be paid in cash. These are all called as monetary assets and liabilities. So when it comes to the monetary assets and liabilities, I will translate them using the exchange rate itself. Current exchange rate itself, I will translate the monetary assets and liabilities. So okay, let me start step by step. So here I call it as a temporal method of the presentation. So all monetary assets and liabilities, this is a monetary asset. So monetary and assets and liabilities, I convert them as using the current rate itself. So this is a monetary asset and liability asset. Account receivable is a monetary asset, but inventory is a non-monetary asset, because inventory is not settled in cash. Inventory is more in the form of raw materials or work in progress. So the settlement is not in the form of cash. So those kind of assets and liabilities, we treat them as non-monetary. So I will not consider that. Fixed assets also is treated as non-monetary. The depreciation accumulated is non-monetary, whereas accounts payable is monetary. So let me convert even this accounts payable also, the monetary accounts payable also, into by multiplying it with the current exchange rate. Short term debt, yes, I will convert it, as well as the long term debt also I will convert it. So these elements I am going to convert as per the current rate itself, as the current exchange rate itself. So which means at least for these entries there is no difference between the current rate method as well as the temporal method. So as far as the monetary assets and liabilities are concerned, there is no difference between the current rate method as well as the temporal method, because in both the cases the exchange is happening at the current exchange rate itself. Now the second point, if at all I am using non-monetary assets and liabilities, the remaining ones, all which don't get settled in cash, we call them as non-monetary assets and liabilities. We are converting them at their historical rate, probably the date on which they were acquired, the date on which they were purchased, whatever it is, the date on which they were settled, all those things get as a part of the non-monetary assets and liabilities. So this being a non-monetary, for each of them, here I have taken the date, the exchange rate on the date at which these were acquired. So, okay, I'll take the inventory, and corresponding to the inventory, I'll take inventory, the exchange rate as on the inventory date. Okay. Similarly, for fixed assets, I will take the amount, the exchange rate based on the acquisition of the fixed assets. And for accumulated depreciation also, I am taking the rate based on that particular number. So, and similarly for common stock also, I am taking this as on the equity exchange rate. Now here I can find out what are my current assets. I'll sum them up saying current assets. So probably I'm seeing a small difference in the current assets. And what about the net fixed assets? This minus this will become the net fixed assets, and hence the total assets in this case, current assets plus net fixed assets, taking the total assets to be slightly lesser than the current rate method. Yeah, now comes the retained earnings part. So here I don't have what is called as a cumulative total translation adjustment. In temporal method we don't talk about it, so I can directly compute my retained earnings as a balancing figure, because my total liability should be equal to total assets. So from here the retained earnings is something that I can directly compute from the balance sheet itself as the difference between the total assets and the summation of these four elements. So this is what is 6,500 is what is coming out as retained earnings. We'll discuss about this retained earnings, but right now 6,500 is what is coming as a part of the retained earnings from the balance sheet. Now coming to the income statement, what we'll handle is whatever are the expenses that are related to non-monetary assets. So inventory, relating to inventory, what is there in the income statement? COGS, cost of goods sold. Relating to fixed assets, what is there in the income statement? Depreciation. So whatever are the income statement elements that are corresponding to non-monetary assets, we again follow their historical methods itself, their historical rate, the rate on which they were acquired. So that is what we deal as a part of the income statement, especially for those elements which are related to non-monetary assets and liabilities. So this cost of goods sold, I will take as per this exchange rate. Then depreciation, I will take as per the depreciation rate, and the remaining things which are related to monetary assets and liabilities, all the other expenses, all the other revenues, I treat them, or I convert them using the average rate itself, which was the same as per the current rate method also. So each one of them I multiply it with the average rate. So I am multiplying this with the average rate. So here comes the gross margin, which is the difference between these two. The other expenses also I am multiplying it with the average rate, right? So from here I get my net income, gross margin minus depreciation minus other expense. So here the net income is working out to be 4,927. One important value to look at, but here we get one more entry, which is the remeasurement gain or loss. So I'll compute the remeasurement gain or loss, and for that, again, this is my retained earning. So I'll find out the increase in the retained earning. What is the increase in the retained earning? What is the increase in the retained earning? In the initial period, the retained earning was 700. Right? So probably what I am doing is the current period's retained earning minus the previous period's retained earning adjusted based on the exchange rate at that point. So the increase in the retained earning is 5219, whereas the net income is only to the extent of 4927, which means the retained earning has really gone up. So the difference of this almost 300 bucks, 292 units of the presentation currency is what we treated as a remeasurement gain. So based on this, the final net income comes out. This actually is called as, in this case, this number is called as a net income before the remeasurement gain. So after the remeasurement gain, we are going to get this kind of a number. So adding up these two gives me that the net income is going to be this number. Now what we are seeing is there is a huge amount of difference. There is a huge amount of difference in the net income between the two methods, in the assets, in the liabilities. Across we are seeing different amounts of differences using the different methods, because the method that we are using, right, though some of the elements are constant in both the methods. What are those elements which are constant? Probably all the monetary assets and liabilities, as well as the income statement items which are relating to non-monetary assets and liabilities, even common stock and dividends. These are the things that are common. Whereas in the balance sheet, rest of them are measured as of the current rate. So if the current, and whereas when it comes to the temporal method, all the other balance sheet items are measured as of some older date. So if in the current rate the numbers are much higher, means the foreign currency means the domestic currency has appreciated. Right? If the domestic currency has appreciated, if the domestic local currency has appreciated with respect to the presentation currency, or probably the presentation currency has depreciated with respect to the subsidiaries currency, we see that the gain is going to be higher. Whereas if the subsidiaries currency has appreciated with respect, if the presentation currency has appreciated with respect to the subsidiaries local currency, then we see that the gain will be lesser or the loss is going to incur. So in this case, we have seen that the presentation currency of the parent has depreciated with respect to the local subsidiaries currency. So because of that reason, so we have to see what is domestic here. So probably even in the earlier slide, when I say domestic currency here, in the earlier slide when I said domestic currency, let me call as local domestic currency appreciates, or from a presentation company's standpoint, from a presentation company's perspective, foreign currency is appreciating. Okay, So here also the same thing. Whenever we are seeing that the local domestic currency is appreciating with respect to foreign presentation currency, then we see that there will be a big gain, otherwise there will be a loss. And compared to the temporal method also, because in case of temporal method different elements are measured at different rates. So if the exchange rate is constantly depreciating, if the presentation's currency's exchange rate is constantly depreciating, you will definitely see that the gain that is realized in the temporal method is much lesser compared to the current rate method. Right? And as a part of this, the remeasurement gain or loss is directly going into the income statement. No entry is made as a part of cumulative translation allowance. So that's the reason we call this model of accounting as screen surplus accounting. Whereas because of this, as the exchange rate fluctuates, we see that the net income also fluctuates more and more. That is why we call in this case the net income is more and more volatile. And when we come to the exposure part, all the non-monetary assets and liabilities, they are treated as per the historical rate itself. Means the current fluctuations in the exchange rate don't impact them much. But the difference actually the exposure comes only with the monetary assets and liabilities, because those are the ones we adjust as per the current rate. So depending on whether the exchange rate is appreciating or depreciating, depending on the net monetary assets and liabilities which the company is having, if it is positive or if it is negative, the exposure is accordingly decided. And so that is the reason we say the risk is more with respect to not the net assets as in the case of current rate method. The exposure is more with respect to net monetary assets, depending on whether the assets position is more or liabilities position is more. The exposure is more towards the assets or exposure is more towards the liabilities. And if the exposure is more towards the assets, a foreign currency depreciation will result in a gain and an appreciation will result in a loss for the presentation country. So we have looked at these kind of calculations. So in this case, some of the things that I can look at is, I am assuming that the exchange rate is appreciating for the local currency, means from a presentation currency's perspective, the exchange rate is depreciating. Right? From a presentation company's perspective, the exchange rate is depreciating. So in that case, we see that the current rate method will result in higher current assets and probably higher total asset, because every asset is measured with respect to the current interest rate itself. The same thing will happen with respect to the liabilities, and because the net asset position will be positive, we will see that there will be a cumulative translation gain, and the total equity position also will be higher in that case. So 12,984, which includes a cumulative translation adjustment of 681. So this can result as a part of a depreciating foreign currency with respect to the presentation currency. And the same way, when I look at the expenses, probably some small revenues and expenses, the dates are slightly different. As far as the current rate method is concerned, all are calculated as per the average rate, whereas when it comes to the temporal method, different elements are computed at different rates. So depending on their historical, the exchange rate as per their rate, it may go more or it may go lesser also, depending on their duration of the time of purchase. So it may so happen that the cumulative translation adjustment which has resulted in a gain here, whereas even this was a gain but the gain is smaller. But it may so happen sometimes this number could be very much negative and this is positive. All these kinds of scenarios are very much possible because of the base. Because of the base at which both these models typically operate, or because of the assumptions, especially with respect to non-monetary assets and liabilities, and also with respect to the income state elements concerning the non-monetary assets and liabilities. Based on the differences that are existing with respect to those items, the net will be either a positive or a negative. The same logic comes when you look at the ratios. Now I want to look at the pure income statement ratios and the pure balance sheet ratios. Let me just take this as 5219.92. Okay, so here let me try to compute a few ratios. Right, let me call this side, or here only I'll take the ratios. I'll take a few pure income statement ratios. Gross profit margin. So I'll look at original. I'll take 3. I'll look at original. I'll look at in current rate method, I'll look at in temporal method. So the gross profit margin, which is nothing but the gross margin divided by revenues. Okay, so 33.85%. So across, all I am seeing, let me translate all these into the percentage form. Okay, so what we are saying is there is no difference in the current rate method and the original method as far as the gross margin is concerned, whereas in temporal method there is a slight decrease. That decrease depends on what is the rate we are using with respect to the cost of goods sold. Similarly, when I am talking about net income margin, net profit margin, at least if I take between this divided by revenues, the same across, even here also we are seeing there is no difference between the original and the current rate method, but temporal method keeps changing. The same way when I look at a pure balance sheet ratio, when I say pure ratio, the numerator as well as the denominator, both of them belong to either the balance sheet, or numerator and denominator belong both to the P&L statement itself. So when I take a pure balance sheet ratio like debt to equity ratio or current ratio, I take current ratio in the original current assets divided by probably current liabilities. I take the summation of accounts payable plus short term debt. So in the original, this is the current ratio. In the current rate method also this is the ratio, whereas in the temporal method it is changing. Similarly, look at debt to equity ratio. The debt, I take both short term as well as long term debt divided by the equity. The total equity part is what I consider. So in this case, if I remove the translation allowance, where I am talking about, total equity in this case is also something equivalent to this, whereas in this case the debt to equity ratio. So what we are seeing is, to a large extent, when I look at the pure ratios, I don't see much of a difference between the original and the current rate method. But if I look at mix, especially like return on assets, net income divided by total assets, right, this is something where things could be different. 20.87, 20.02. The reason is here we have translated them at the average rate, whereas in the assets they are translated at the current rate. So obviously if we see the foreign currency is depreciating with respect to presentation currency, we see these kind of ratios where the income statement is in the numerator and balance sheet is in the denominator. We see a decrease in the ratio, whereas if the foreign currency has appreciated with respect to the presentation currency, then we see the reverse. The ratio will keep increasing. All these kind of things, sensibly you have to make assumptions and probably make some small numbers here and there to understand whether each of them are really increasing or growing or falling. But in case of temporal method, all kinds of possibilities can come into picture depending on the timings at which each of those non-monetary related elements are typically represented as a part of your financial statement. Alright. So in this case, just to summarize, some of the important things that are worth looking at is, check out if the foreign currency has appreciated or depreciated. Here I said these numbers are per 1 unit of local currency. So you have to really see. So because this is per unit of local currency, I am saying in this case the local currency has appreciated, which means the foreign currency has depreciated. And also see what kind, especially if we have to analyze whether something is going up or going down or something like that, see what rate is used to convert the numerator as well as the denominator. If the same rate is used to convert both of them, then the ratio will not change. And in case of foreign currency depreciating, we may very well say that the current rate method will represent a higher number compared to any other method, compared to the temporal method. Similarly, for the denominator also you can look at what rate is what we are using. So is the numerator growing more than the denominator, or numerator going lesser than the denominator? All those kind of things need to be understood and handled. So that is how we analyze whether a particular ratio will go up or go down because of these multinational operations or because of the method that I am using to translate. Because in this case, it all depends on whether the functional currency is the local or the presentation. If it is local, I am going ahead with the current rate method. If it is more of the presentation currency, I am going with the temporal method. So it all determining which one is purely a management initiative, whereas from an analyst point also he has to look at why this particular company has chosen this particular kind of a method. That analysis has to go in detail. Alright. So now the other section which I am going to look at here is, in case the subsidiary is operating in a hyperinflationary economy. In case the subsidiary is working in a hyperinflationary economy, the simple definition of the hyperinflationary economy as given by US GAAP. IFRS did not define so much on what do we mean by a hyperinflationary economy, but as per GAAP, if the cumulative inflation exceeds 100% over the last 3 years, so which means at an approximate growth of 26 odd percentage per year, and our accumulative growth of 100% means almost the prices doubled within 2-year period for all the basket of goods. That is where we say cumulative inflation is 100%, and in those cases or in those economies we typically call as a hyperinflationary kind of economies. And in case my subsidiary is present in a hyperinflationary kind of an economy, how do I handle the financial statements as per GAAP and IFRS? Because there are some differences as per US GAAP and IFRS in terms of handling the subsidiaries present in hyperinflationary economies. So let's look at that particular aspect, and probably we can use our current data itself to handle that situation, assuming that the subsidiary which we were dealing till now was operating in some hyperinflationary kind of an economy. So, especially what the US GAAP says is, whenever the economy is a hyperinflationary economy, irrespective of the model the subsidiary is working, you treat the functional currency as the parent's presentation currency itself and use the temporal method to translate all the elements of the balance sheet and the financials and the income statement straightforward. If you see that the particular subsidiary is operating in a hyperinflationary environment, irrespective of what its functional currency is, US GAAP says you convert the functional currency as the presentation currency itself and use the temporal method to restate the financial statements from the local currency to the presentation currency. That is the way the GAAP suggests the handling of hyperinflationary subsidiaries. Whereas when it comes to IFRS, what it says is you restate for inflation based on the price index. You restate all the assets and liabilities, income and expenses, revenues and expenses of the subsidiary using some price index, and based on that, after that you translate to parent currencies using the current rate method itself. That is what is being suggested by IFRS. So in that, all non-monetary assets and liabilities you translate based on the change in the price index. So for the same example, let's assume that this subsidiary is a hyperinflationary country the subsidiary is operating. Then what it says is all non-monetary assets and liabilities you adjust based on the price index change itself, which means what I'll do is all these original numbers I multiply with the end of the year price index divided by the beginning of the year price index. That is what we call as the price index change. So initially I'll restate all the non-monetary assets and liabilities at that particular rate. I restate all the non-monetary assets and liabilities at that particular, the price change in the price index during that particular period, beginning of the period to end of the period. I am restating it. All monetary assets and liabilities don't change at all. So monetary assets and liabilities, I'll take them as it is. Right, all the monetary assets and liabilities, I'll take them as it is. This is what we do as a part of IFRS. All the monetary assets and liabilities, I don't even convert. The shareholders equity also, you use the price index change. So the shareholders equity also, I go with the way I have done the inventory itself. So this is what are the changes that are going to come based on a hyperinflationary environment. The first step that we are going to do, all non-monetary assets and liabilities, multiply it with the inflation rate, which is the change in the price index from the previous period to the current period, right? Whereas all monetary assets and liabilities don't do any kind of adjustments. Similarly, when it comes to the income statement, so here also the total assets should match my total liabilities. So I will directly take this to be my total assets. From here I'll get back to my retained earnings here. So this is the kind of retained earnings in a hyperinflationary economy. The same thing I can go with the income statement, but this is based on the average, because I am taking the price index from the date of transaction. I should not take from the beginning of the period. So generally I will go with the average price index for each one of them. So I will restate all of them based on the average to based on the current to the average, based on the current to the average, because assuming that I have purchased them at the beginning, somewhere in the middle when the inflation rate was something like that. So that is how I am restating all the income in my income statement. All right. So the cost of goods sold, the depreciation, the other expenses. So from this, what I can get is my gross margin, and from here what I am going to get is my net income and the net purchasing power gain or loss. Now here all I am looking at is what is the change in the retained earning. What is the change in the retained earning here? Probably if 700 was the cost of equity in the earlier period, the change in retained earning 6,400 minus 700 restated again as of 150 by 100. So 5,350 happens to be my increase in the retained earnings for this period. So which means it's not a remeasurement gain in this case, it's a net purchasing power gain, which I take this as 5,350 minus a net income of 3,057, making it almost 2,200 is a kind of purchasing power gain that I have got during this period. Now once I have made this particular financial statement adjusting for inflation, then I will translate it into the parent's currency by using the current rate method itself. I'll multiply all the current numbers with respect to monetary. All the balance sheet items now are adjusted to the current rate, and I'll multiply all of them with the current exchange rate. Both the assets and liabilities I'll multiply with the current exchange rate. Revenues and expenses I'll multiply with the average exchange rate during the period, and finally find out what is my cumulative translation adjustment during this process. That is what I am going to do as a part of working for hyperinflationary kind of an environment. So one thing that needs to be understood is the disclosures, especially for a firm which is having multiple subsidiaries in multiple countries with multiple currencies. Becomes very difficult to find out what is the CTA, and even if I know the CTA, it will be one single value. I don't know the breakups, so which means I don't know the exposures to each of the currencies. What is the exposure to currency 1, currency 2, currency 3, which of them are positive, which of them are negative. So all these things become very difficult, but even the disclosures are not good enough in terms of the analyst assessing what is the exposure of a particular countries with respect to the currencies of other countries with which it is doing the business. That part becomes very difficult because even the disclosures are not that detailed. There is a very minimum amount of disclosure that comes in each of the cases. But at least if an analyst is comparing two firms, one is following a temporal method, the other one is following a current rate method, at least these two can be compared on the same lines by adding the CTA that got generated. You add it to the net income and compare with the net income that is getting generated with the temporal method, so that at least to some extent the comparisons can be more or less apt. That is one thing that the analyst can do. And when it comes to the tax part, what we generally see is every country has different tax laws, means the subsidiaries must be paying the tax as per their tax laws in their countries. So from the parent's perspective, generally for all the taxes which the subsidiaries have paid in their own countries, the parent country will be getting tax credits for the same, which means whatever the tax which the parent country has to pay is only on the balance, which means finally the country is taxed based, the parent company is taxed purely based on the effective tax rate of the domestic currency itself. So the effective tax rate comes purely from the tax that is shown in their income statement divided by the profit before tax, whereas the statutory tax rate is like, okay, the corporate tax rate is 34% or 30%, whatever is defined as per the jurisdiction of the operation, that is the statutory tax rate. And what it says is, especially for a parent that is having multiple subsidiaries in multiple countries, it is required that a reconciliation of the financial statements has to be done based on both the tax rates, so that the analyst can use this information for future projection kind of purpose. And what all should an analyst look at while doing the valuation of such kind of a firm? The revenue side focus more on whether looking at the growth in the revenues, see whether the growth is coming because of changes in volume or price, or is it coming because of change in exchange rate. If the sales have grown because of change in exchange rate, probably it is not sustainable, because you cannot grow based on the change in the exchange rate forever. But if it is growing based on volume or price, it's a growth of the business, so it becomes more and more sustainable. So also look out for what is the perspective of the management with respect to the changing currency effects and their business in the foreign countries, which can generally be found as a part of the management discussion and analysis. But at the same time, the analyst can use his own tools like sensitivity analysis to see what if the exchange rate goes to a certain number versus a certain number. Based on that, he can get into a more realistic forecast of the sales, which can help him in doing the valuation of the firm more and more better. So the key thing as a part of this session is understanding the multinational operations how they are treated as a part of the financial statements, and how the exchange rate fluctuations will play a role in terms of the valuations of the company. So I hope you are able to understand quite a bit of it in more detail. If you have any further queries regarding the same, you can get back to me by giving me a call on this number, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.